Hi there, how are we all today? I'm Karen Beckham, so hopefully you can see me quite nicely. I was earlier on wearing a lovely orange top, only to realise that I matched with the background, so I went and quickly got changed. So hopefully we're all good. You can see me now, I'm not camouflaged. This afternoon I'm going to be talking to you all about retirement ready, having more choice and less stress. So I think that's an awesome topic for a lovely, cold wintry day down here in Christchurch today. So I'm Karen Beckham. I'm a financial advisor, financial personal trainer here at Enable Me. A little bit about me. I was in banking for a really long time, over 30 years. So I've got a lot of experience in banking and finance. Part of my roles in the banks that I worked in, I was a bank manager for quite a long time and a premium centre manager. So the premium centre manager role was very interesting because I was looking after high income, high net worth clients. So have had a experience dealing with a good range of people over the years. My specialities is really anything to do with finance. But my job here at Enable Me is to help optimize people's outcomes and hopefully give you a better financial future. So our presentation today is provided for information purposes only. The content is presentation is not suitable for personalised advice. It is just regulated financial advice. So I'm going to ask a question to start off with about how confident are you on track to fund your retirement at the moment? So our answers are yes, I'm pretty confident. I have enough. Yeah, I'm pretty much sure I'm going to be okay. The answer I hear a lot, nope, I'm not on track. And another one, which is a bit scary, which is I don't have any plan to fund retirement. So I think, Amelia, we might have a little poll going there. Is that right?
So the poll results are showing. Can you see them, Karen?
Oh, no, I can't see them. I'm
That's
blind.
okay.
Sorry.
I can tell you what they are.
You
So
tell me what they are.
so there is 7% saying, yes, I'm confident I have enough. 48% say, yeah, I'm pretty sure I'll be okay. 41% say, nope, I'm not on track. And 5% say, I don't have any plan to fund retirement.
Okay. Wow. So it's 46% of people have either on not track or they don't have any plan, which is a bit scary. Nice to see 48% of people thinking, yeah, I'm pretty much sure I'm going to be okay. So it's kind of one of those questions like, I'm pretty sure, but we want to be a bit more sure than that. So that's good. Thank you for that, Amelia. So I think at the end of the day, we all want a comfortable retirement, but many of us don't know if we're on track. So just a bit of disclosure about myself. So I will be 58 this year. So I am 7 years away from retirement. And I'm like very aware of the fact that I have to get pretty serious about my retirement planning now. My husband's a year younger than me, so he's thinking I'm going to work for a little bit longer so that we retire together. Interesting concept. Not quite sure if I'm agreeing with that. But we do need to make sure that we are on track to retire and have that comfortable retirement that we all like. So this topic is very, very dear to my heart at the moment. So the presentation itself is exactly what I'm going through. And I'm sure a lot of you out there will probably be feeling the same way. Right. So, wealth in retirement creates options about what we do and what we can do. So, we have choices about where we live and how we live. It's about looking at maybe our retirement early or scaling back our hours. And a lot of people that I meet do say that's what they'd like to do. A lot of people are saying to me that they don't necessarily want to work retire at 65. They might retire at 65 and work part time for a while. And a lot of people want to retire a little bit earlier and full time retire at 65. And some people are just going, I cannot wait until I'm 65 and that's it. Over now, I'm retired. The other things we've got to think about is the level of care that we're going to need in retirement, whether or not we want to leave a legacy for our family or maybe for a charity, and how we can help our kids if that's something that we want to do. So, we do need to have a buffer in place in case something goes wrong, but we do need that really good plan because it helps us understand what life is going to look like. Otherwise, we can run out of money or stop doing the things that we want to do. So it's really important to have a good wealth creation plan. So when we talked about how New Zealanders felt about retirement, officially 50% of people aren't prepared for retirement. 70% think that they're going to need to work past the age of 70. And 34% could maintain their current lifestyle for 10 years on their retirement savings. So interesting that we had 48% saying that they were pretty much okay and 7% were pretty confident. So we've got a really good mix of people out, in the audience today. So we do need to get a bit more confident than these figures. So some of the different options that we can consider to, help fund our retirement, and this is, as I said, some people want to work longer. It can be a choice, but we don't want it to have to be. We want to have that choice to be able to do it. Some people say, well, I'm going to downsize my home, or as I call it, right-sizing your home. So it's finding a property that maybe downsizes a mortgage or you get a bit of capital out of it. Some people think that they might get an inheritance, which I always think is a bit of one of those ones where you may not, so don't count on it. There could be a sale of a business. Reverse mortgages are getting a bit more popular these days, and that's probably because we haven't always prepared as well for retirement as we could do. Or we do the whole spend less in retirement, which means have a smaller life in retirement than what we've been wanting. We've all worked really hard all our lives, so we should be getting the retirement that we deserve. So super's not going to be enough to retire on unless you're mortgage free, you work to 65, you're not having to help your kids, and you're wanting to have a no frills lifestyle. That's not me. For any of you that know me, I've always been a bit of a shopper in my life. I'm moving my money personality slightly because I know that I've got to change some of my spending habits. But we want to have a nice lifestyle leading into retirement, but we want to be able to continue that at a nice level sort of transition from working full-time until retirement. So we do need to look at things a little bit differently. So where we start is at our starting point. So we need to secure our financial foundations. And our financial foundations are things like understanding what our cash flow looks like. It's about being able to track where your money's going, having a good plan in place, having the right insurances, having the right KiwiSaver or investment funds, and all of those legal foundations as well, which are things like power of attorneys and wills. So we do need to understand what we need. We need to determine where the money is coming from in retirement, and we need to gauge how we're currently tracking. You need to establish that savings gap. So we need to know how much that gap is between being able to live the nice, comfortable life that we want in retirement all the way through retirement. So we're not sort of getting to 65 and thinking, good, I've got 5 good years, and then after that it's all downhill. So we don't want to do that. Nice and level all the way through is what we're aiming for. So as a rule of thumb, to have that comfortable lifetime, we believe that you need roughly 25% of your annual lifestyle costs, and that's because potentially we're going to live 25 years into retirement. We do need to be mortgage free, and as we talked about, some people's strategies is that they will downsize their home, and that is to either get mortgage free or get some capital out of that property. And it's really important to have financially independent children. That is harder these days. I know there's a lot of statistics around the fact that a lot of people in retirement are actually funding their adult children. Not a good thing to be in the position of doing, but it is just the life that we lead these days. So that gives us, I got through a few slides there. So that gives us a bit of an idea of what we think we might need, but it is very personalised as to how much you need because it depends on what your lifestyle is, but roughly 25% of your lifestyle costs. So with a wealth plan for retirement, we need it to be a bit flexible because things do change. We do need it to be dynamic because if we just do the normal things that we do, which is just the term investments and savings accounts, we're not necessarily going to get where we need to be. We need to build in some buffers for a rainy day. We had lots of those recently around the country. We need to enhance our positive behaviour and spending habits. And this is one I'm really good at because this is one thing I've had to do. So I can talk a lot about that one. We need to have those very strong financial foundations. So securing your financial foundations, as I said before, a lot of it is about your money habits. It's about deciding where you spend your money, why you spend your money where it is, and understanding how you can stop some of the bad money habits that you might have had creep into your life. It's about goal setting. So when we talk about not having a plan, it means that we really don't have much in the way of goals set for what we need to do to get where we want to be. Cash flow management is really, really important. So we talk a lot about this in Enable Me, because often if we've got a nice plan about what we want to do, a spending plan or a budget, as a lot of people call it, it's fine to have it written down. This is what I think I spend, but you need to actually understand, do you really spend that? So the tracking and the spending plan going hand in hand is that good financial cash flow management. And mortgage management, if you've still got a mortgage, there are ways to get your mortgage repaid much faster than you are if you're just paying what the bank wants you to pay on a fortnightly or monthly basis. So very, very important to structure that mortgage debt to get rid of it as quickly as possible. So when do we start? Well, obviously, we want you to start as early as possible. Hopefully, everybody out there started with their KiwiSavers when KiwiSaver was introduced, have seen that those KiwiSavers have built up over time, but there's no time like the present. We really want to start. If you haven't done something, get started today. Warren Buffett's quote is a really good one. Somebody is sitting in the shade today because somebody planted a tree a long time ago. So all of those plans or things that were set up, the infrastructure that was set up years and years ago, benefits us today, as long as it's well maintained. A lot of people do ask about KiwiSaver. Is it still worthwhile investing in? Because there have been some changes. Absolutely, it is worthwhile investing and continuing to save in your KiwiSaver. The things that we like about it is that it is deducted from your pay. So for most of us, it's been coming out of our pay for years and years and years, and we don't even really notice it. If it suddenly went into my pay and I had the choice, there is a good chance that it might be spent on something like a holiday. So for me, it's great that it's locked away until I turn 65, because as a reformed spender, I need it to be secured. So we do also get our contributions from our employer, which is fantastic. So that's just recently gone up to 3.5% for most people. But it includes some free money from the government, not as much as it was before, but it's still really worthwhile having. So please, if you can do the minimum of 3.5%, if your employer does 3.5%, great way to just squirrel that money away for retirement. But it shouldn't be the only retirement option that you have. I do talk a little bit when I see clients about, if you're wanting to increase your KiwiSaver contributions, just be aware that there are some restrictions on being able to take it out. So if you wanted to retire prior to 65, those restrictions can stop you doing it. And unfortunately, the ways you can take money out before you turn 65 aren't particularly nice reasons. So at the moment, you can take it out if you leave New Zealand permanently, if you're in financial hardship, but generally that's only about 3 months worth of your expenses. And if you are terminally ill with less than 12 months to live, so not great, or you die. So we want to make sure that KiwiSaver is there in the background. We're making the most of it. But if you are wanting to invest, maybe look at something outside of KiwiSaver if you want to invest more than the minimum. But it is something that's quite personalized, so we do talk a lot about that when you come and see us for our financial consultations. So the default retirement projections, we kind of work until we're 65, we pay off our mortgage, we start to access our KiwiSaver, which is that little green line, and our KiwiSaver lasts us until, well, hopefully longer than the age of 69. But for a lot of people, when we sit down and do their projections, it doesn't last a lot longer than that. So it's really important that you look at other ways of investing and making sure you get mortgage free earlier than the age of 65. So I'll show you some more information on that shortly. So yeah, to be comfortable in retirement, we really, really do need you to get mortgage free as quickly as possible, because that gives you the ability to invest and grow a little bit of wealth in between those few years there. So this is a different slide. It shows you what the difference is if you're able to repay your mortgage earlier. So if you repay your mortgage, say at the age of 55, then obviously that gives you that 10-year time frame where you can actually start to grow wealth through investments of one kind or another. And that obviously makes quite a big difference, because that's an extra 10 years, that's that dark green line where we have that wealth creation. Then our KiwiSaver jumps in at the age of 65, which is the slightly lighter green. And then we have two different options there. We've either had some retirement planning, so that can mean that our money can last out to 80, or if we've just got our retirement funds that we've used and we're just accessing them, it might last 80 rather than 90. So it's really important to get some really good advice about what to do with your money once you're mortgage free, and investing. Right. This is an absolutely wonderful story. Catherine and John, they are real people. I don't know if that's the photo of them. I'm not sure. They're Alicia's clients. But this story is really lovely. This is a recent story that happened with some of our clients at Enable Me. They came to us in 2019. What a great year, just prior to COVID. They were in their late 50s. They had what they considered to be a big mortgage to pay off, but they wanted to retire when they were 65, but they weren't sure that they were going to be able to do that. And we do see this a lot at Enable Me, where people think they're going to be paying it off until they're 65. So they came to see us in 2026. So this has only happened last month. They became mortgage free. They had an investment property and their KiwiSaver building wealth in the background. But the retirement cash flows that we've projected for them is that their money will last until the age of 93. So hopefully that's as long as they last. But that is such a big difference in their outcome. So they've also got an emergency buffer. So if anything goes wrong, they've got a buffer of a year's worth of outgoings saved up. So what happened is that when they came to see us, we thought that their current mortgage term with the bank was 18 years. We thought they'd get mortgage free in 7 years. They were on their Enable Me program, and I'm sure it was Alicia that was helping them. So instead of getting mortgage free in 18 years or 7 as we projected, because they got really involved in the program and really focused, they actually repaid their mortgage in 6 years. So they ended up being able to save about $61,000 in interest that they would have paid to their bank by paying off their mortgage faster. And they've been able to instead grow that emergency buffer, which is equivalent to the year's worth of outgoings. But they also bought in that time a new build investment property, which is there to grow wealth over the next few years to provide them with a little nest egg when they need it later on. They also upgraded their cars. And they've lived their lives on their own terms. So they've had holidays to Rarotonga with themselves. They've had their extended family go there. They've had a really good life, not just focusing on getting mortgage free, because a lot of people think that focusing on getting mortgage free means that you live a little life, because all you're doing is trying to focus on that mortgage. But you don't have to, because it's all about getting the mortgage structure right and really working with what is important to you and focusing on spending the money that you enjoy spending it on, but not frittering it away. So what they have said is it makes me feel a lot more in control of my goals and my destiny. It means you don't have to have those money worries. Money worries are the pits, and I feel like I've had that until now. So it's really nice to be able to change that mindset about how you feel about money. I know a lot of people have sleepless nights worrying about money. So as we say, we're wanting to sort of change that for you to help you have a nice, comfortable retirement. But we want you to, have more and have less stress. So we have a lot of options about what we do with our money and how do we create wealth. So we're hopefully mortgage free. We're looking at our options. We've got things like shares, we've got bonds, we've got managed funds, gold, collectibles, digital currencies, ETFs, we've got index funds, we've got forestry, term deposits, property, businesses. There's a lot to choose from. And it's like, well, where do I put my money? Because there is a lot to choose from. And that's why it's really important to get the right advice about what your next step is when you're investing. So not all of these different types of investment options suit everybody or your situation, and some do require a bit of help from some specialists. But we've got to consider if you're going to get a higher return, there might be a little bit more risk involved. So we just need to know what your feeling is towards risk. If you're feeling a bit risk adverse, some of these might not be the right options for you. So sitting down with a proper financial advisor, not the neighbour over the fence that's had a good return on something, is really important. Get the right advice. So again, when looking at the balancing of the risk and return, so we've got down the bottom here is our cash. So that's pretty much just on-call savings account. Some people have money sitting under the mattress, hopefully not too many. But obviously that's low return and low risk. We move up the scale slightly. So our term deposits and bonds, they're slightly higher return and a little bit more risky, but not too risky. And of course, we're in the environment now where the Reserve Bank is saying maybe the OCR might go up in May, and it may go up a few more times. So everyone out there that's got money sitting in the bank's going, yay, I'm going to get a slightly higher return. But the returns are still quite low. So, I mean, if you're getting a return of 3% and inflation's running at 3%, your money is just neutral. So you're actually not getting anywhere with it. So it is a lower risk, but it is a lower return. Then we end up with our managed funds type products, and they obviously have a slightly higher risk depending on where you're looking at investing them, and the returns are slightly higher as well. Then we have property. So property is one that historically has provided a very good return for people over the years. And it can be considered to be a slightly higher risk if you're not getting the advice about buying the right investment property. So it is very, very important that we do that. We buy the right property. We don't want to buy a lemon. It's bad enough if you buy a bad car, but if you buy a bad property, it magnifies the problems. So there's still a good investment there. There's a lot in the media about whether or not they are a good investment, but we do really have to be careful with that recency bias, because that bias has been in the media recently. But historically, property's always done very well. Then we have our shares, which are really interesting at the moment. So managed funds and shares, we've all probably seen our KiwiSavers, our managed funds or our shares bobbing up and down with what's been going on in the Middle East. So again, a bit of a higher risk and a higher return there. And then a business, if you know what you're doing with regards to business, fantastic. If you're not a business owner or had businesses before, that could be quite high risk for you. But the bigger the savings gap, the bigger the needs, bigger gains that we need. But we have to be really, really careful that because we've got a big gap, we don't take the wrong kind of risk. So really important to get good advice about that. So what we believe at Enable Me is that if your retirement gap is greater than 300,000, you're probably going to be likely to need to leverage to bridge that gap. So I will talk in the next slide about leveraging, but this is a very important slide to think about. So how leveraging works. So the power of leveraging is really using your property, which hopefully has no or a low mortgage. So hopefully you've got no mortgage, but if you do, if it's a small amount, you can leverage against the value of your property with the bank. So the bank is then going to lend you enough money that you can buy a property, which is obviously a high value investment, because it's not your money, it's the bank's money that you're using to invest. Whereas if you're thinking, well, I've got $160,000, what should I do? Well, you could put it into a managed fund. And I know some of the managed funds at the moment are around about 5%, which is after tax and fees. So that's not too bad. So if you have your $160,000, that means you're going to get a return of about $8,000 a year. But if you're able to leverage and use that property plus some of the some investment, and you leverage and your property gain is 5%, because it's a bigger item, it has an asset value of, say, $800,000 for the house. When that $800,000 house goes up in value at 5%, the net return is about $37,000. So you get a better return, but you're also using the bank's money. So you might need to top it up, but it's the same as if you're putting money regularly into a term investment or into a managed fund. So it's a different way of looking at it. So we do talk about getting yourself mortgage free before you retire, but that's on your own property for your personal mortgage. borrowing to buy an investment property is a different sort of kettle of fish. So don't worry too much about that. But it is a very interesting thing to look at, and leverage is a very powerful tool that we have. The risks of leaving your money in the bank. So I've actually got my mum and dad down staying with me at the moment. And my dad, I always used to say, was like Mr. Midas. He used to sit and look at his funds going up and down in value when he had his managed funds. And at the moment, he has got some money sitting in term investment, and he keeps saying, what do I do with it? And he said, oh, it looks like I'm going to get 3% at the moment for the next little while. And it's like, well, yeah, Dad, but if you leave that money sitting in the bank account earning 3% and inflation is 3%, it's actually not going anywhere. In fact, it's going to go backwards because inflation potentially is a little bit higher, over more than 3%, and it might go higher still. So when we look at the value of inflation, the $100,000 today, to keep that value in 5 years' time, you'd have to have 115,000, nearly 116,000 to keep the value of today's 100,000. In 10 years, it would be $135,000 in today's dollars to have that $100,000 buying power. And then in 20 years, it would actually be about 180,000. So I always remember when I first joined the bank, we had a client, she's an older lady, and she had $100,000 in a term investment. Now, that was a lot of money, because back in those days, you could buy a house for about 140,000. So I'm talking, well, back in 85. But back then, that was a lot of money because it was equivalent to a house. But over the years, that $100,000 got less and less and less, and it got to the stage that wouldn't have even been a deposit on a house, and that's because inflation has eaten away at that investment, and she just couldn't keep up with it. So as we go into retirement, we start to decumulate, because we've been spending all our lives paying off mortgages, accumulating wealth and savings. And as we go into retirement, we have to change our mindset to start to decumulate. So what we start looking at is the change of our strategy. So it's changed because our cash flow needs change. So we don't have a mortgage, so we've got the money from our mortgage. We start to think, well, what do we do with that? We've got our kids. We might not need to help them out as much. You need to think about the return you need versus the risk you're comfortable, and can you absorb any volatility? And we've seen the volatility in the marketplace over the last few weeks with what's happened in Iran. But what we need to start to do is, with the decumulation strategy, is start to think, well, how do we start to gradually withdraw some of our money over time, so that we can actually make sure that the assets that we have are appropriate for how long we need the money for. So it is a bit of a change in mindset, and it's where we need to think, okay, if we've got savers out there, savers keep saving so that they get to their goal of how much they need. But when they're in retirement, they need to be able to give themselves permission to start to spend a little bit. And our spenders, we don't want to just spend all of that money in one go. So we do need to have a bit of a plan of how we decumulate our money. So we have a few different options of how we decumulate our wealth. So our options are that we can live off our investment returns. So if you think you've got $100,000 in the bank earning 3%, that really does limit what you've got to spend. If you've got a investment property, you could live off of the rent if you have no mortgage and you can cover all the other costs. So that's how we live off our investments. Or we can do a withdrawal of a set amount each year. So we might know that our super is whatever super is going to be when we retire, and we need an extra $50,000 a year or $100,000 a year to live off, and we can actually then withdraw that as a set amount as we go through there. Or we can take out a percentage of our wealth and have that sort of scheduled to be paid to us on a regular basis over the rest of our lives. There is the phased approach, which is a really important one to look at, and that is just a matter of having different assets maturing at different times and having those monies sitting in a little pot for you to withdraw when you need to. So we sometimes call those buckets, and the buckets can be what we need today is our short-term money, and then we have money put away for 3 and 5 years, and then as we need that, there's money available to you. So there's a few different strategies of how that works, but we do give a bit of advice advice on how to do that, our wonderful wealth managers can help you with those sort of plans as well. So we do have that whole phasing in of retirement. So we don't retire and take all our money out of KiwiSaver the day that we turn 65. We do need it to sort of last over a period of time. But our lifestyle changes when we retire. So I know from my mum and dad when they retired, probably the first 10 years, they travelled. They were going off here, there, and everywhere. Half the time we didn't know where they were, living absolutely their best life, like so envious of the lifestyle that they lead or have led. They're getting a little bit older now, so they're not quite so wanting to travel. Probably COVID didn't help that, and there's been a few health issues, so they don't travel as much. So in that first 5 to 10 years, which we call the honeymoon phase, they were probably spending a little bit more money because they wanted to live that great life. So we kind of had to think about where that money was sitting, and they needed it somewhere in sort of a bit of a low risk because they didn't need to have too much fluctuations. But now they're getting that little bit older and they're a bit less active. They do have a few more health concerns. The amount of money they need is actually reducing slightly because they're just not going out and doing the things that they used to. So they need to make sure they're investing in income and growth just to sort of, make sure that they've got enough money to last for their next stage of life. And in our final years, we can actually end up with some very, very expensive type of care needs. Depending on how healthy we live, we don't really know what it's going to look like, but it still could be about a 15-year time horizon. So if you're needing to go into any kind of residential care, it is expensive. And that's sometimes when people say, I will get an inheritance. Well, they might not, because those final years, if you're needing to have more care, that can quite easily eat away at the money we've put aside. So we need to make sure that we are planning for those different stages in our life, because even if we do go into a rest home, we want it to be a nice rest home, right? No one wants to go into somewhere grotty that they have to live in. We want to have the nicest one we possibly can, the best care that we can afford at the time. So it's important to understand those different time frames with regards to how long our money is going to last and where we need it to last. So how do we future-proof your wealth? Well, we look at other things that have to be set up for us. So there's future-proofing is sort of protecting. So we still need to have insurance policies. Now, depending on what your situation is, my situation is that my husband and I are second time around us. So we both have a family, not together. They are our family, but my husband had two children in his previous relationship. I had a daughter. So we've sort of thought about, well, how do we sort of cover if one of us dies? It's really, really complicated as to how to do it, and it's not something you really want to think about. But things like insurance policies can be really helpful, because if your main asset is the home you're living in, and you have a child that believes that when you die, they're going to get your share of the house, well, what's your partner going to do? Don't want them to have to sell the house. So sometimes an insurance policy can be something good that can actually be put in place to give to the children when you pass away, and then later on they get the house when your partner passes. Trusts is still something that are worthwhile looking into. You need to get legal advice about that. Some people want to make sure that they have that financial legacy to leave. But it's really important that you do that in the right way. So have a good talk to your solicitor, make sure that your will is in place and that it is actually protected. There's a lot of different things that can impact on your will, because your will should be something that your loved ones follow and say, well, this is what they wanted. But sometimes people want more than what's in the will. So make sure that you get good legal advice about that. Power of attorneys are really important to get. In fact, if you haven't got a will and a power of attorney, put it on your list of number one things to do after seeing us. Get those put in place. A power of attorney, if you don't have one, there's two forms. They're enduring power of attorneys. One is for property and the other one's for personal care and welfare. It's really important that you have those in place before you need them. So if you are mentally incapable of making a decision, you will need someone to act on your behalf. So that's where the power of attorney comes in. They then become you, and they're able to make decisions on your behalf. If you do not have a power of attorney, your loved one will need to go to the court. There'll be two lots of solicitors, one for you and one for the person wanting to look after things. There's a lot of cost involved in it, and generally you have to go back to court every 3 years, and there's a lot of documents that need to be kept. So getting those power of attorney in place is actually a really good investment for you and for your loved ones, looking after them. Also, as I mentioned before, the rest home subsidies, that's when, if you need to go into care, quite a portion of your money could get used up before you actually qualify for a rest home subsidy. So, I feel like I've been talking at full speed. So key takeaways at the moment. So we really do need to understand what our goals are and what our timeframes are. Obviously, we don't come printed with an expiry date on us, so we don't really know how long our money is going to last. But we need to make sure that our goals that we have and the things that we want to do aren't just for today, like live a good life today, but you want to have a good life going into retirement as well. So we've got to understand our timeframes. We want to really determine what our strategy is and have a great plan. We want to check if your investments are working for you at the moment. And we've seen with the volatility in the Middle East, I think we're all thinking about different ways of investing at the moment. So make sure that they are the right investments and they're working for you. Determine how you're going to manage your finances once you retire. Very important. Think about, you have no income coming in. What you've saved is what you've got to live on. Are you going to be able to do that? And make sure that you've protected your wealth and prepare your legacy. Very important. So I'm going to talk a little bit about what to expect if you come and see us at Enable Me and what is a financial consultation. So it's a session that takes around about 90 minutes. It is a strategic session. All of our coaches at Enable Me are all financial advisors. So we love to sit down and talk to our clients about how we can help you achieve the goals that you want to achieve. If you sit with me, it might be slightly longer than 90 minutes because, as you probably guessed, I do talk a bit, but I can be very lazy when I need to. But we do like to get the full picture of your finances. We need to understand what your assets are, what your income is. We need to understand what your spending looks like. If you've got any debt, we need to understand your money mindset, because that really gives us an idea of what you're likely to do with your money going forward, and why you do or don't do something, and looking at those goals. We do look at ways of identifying inefficiencies or wasteful spending. So sometimes it's things like bank fees, not a huge amount of bank fees these days. Often it's mortgage structure. Sometimes it can be just overpaying for things that we see regularly in people's budgets where you could actually be more efficient. So we do look for those inefficiencies and finding ways that you can actually reduce your spending but still live a good life, but just be more efficient with your money. We do then look at what your trajectory looks like. So we can look at your income, your outgoings, where you want to spend your money, what your longer term goals are, because sometimes it's replacing vehicles, it can be traveling and things like that. And then from that, we can sort of determine what the future is going to look like financially and put a plan together for you. During the 90 minutes, we obviously can't do a full financial plan. It is really about getting to know you and understanding how we can help. And then from there, if you want to join us with one of our wonderful programs, we will help you over the next 12 months to achieve the goals that you're wanting to achieve. So it's a fantastic program, very supportive, very motivating, a bit of accountability with our coaches, but it is a great session. And I had a lovely lady that came to see me yesterday that unfortunately, due to a really unforeseen investment that she made, she unfortunately lost all her money and actually owed a bit of money to the bank. And she really didn't think there was any way that she could get out of it. She still had 10 years till retirement with quite a big debt. We sat down yesterday. The mortgage that she had was over 15 years on with no properties. Unfortunately, it was just a reverse, it was a negative equity loan. But we could actually get her mortgage free really quickly and then save for her retirement. So she left, she gave me a big hug, which was lovely. But all our coaches, we just want to sort of help our clients get ahead. So the cost of the session to see us, if you book today before the end of the evening, I don't know if it's like the colour here, pumpkin colour, before midnight. But if you book today, the financial consultation cost will be $100. If you book after the session today, after this evening, it'll be $149. So please scan the little QR code there, book in to see us. We've got quite a few strategic coaches spread throughout the country. You can either come in and see us in person or on a Teams meeting, but we'd love to see you and help you and just give you that sort of comfort that you're either on the right track, or if you're one of the 41% that says nope and 5% with no plan, lets us help you get a plan in place. And if you're one of the 52% that have a plan and feel like they're okay, just come and talk to us and make sure that you're doing the things the right way around. So that's my part of the presentation. So we're going to go next to the question and answers. So I think, Amelia, we have some questions. Is that correct?
Yes, we had some questions. The first question, someone's asked in a chat, they wanted a bit more clarification about like figuring out how much you need for retirement. So they wanted some clarity about the raw fund we had for that in terms of the 25 times annual lifestyle costs, in addition to being mortgage free and having the financially independent children. So can you speak more a little bit towards that?
Yeah, absolutely. So the 25 times your lifestyle cost is because potentially when we go into retirement, our life expectancy would be probably 25 years in retirement. We don't know when we're not going to be here. As I say, we're not printed with an expiry date, so we don't know actually how long we need our money to last. But generally, as a rule, that 25 years would obviously take us to about in our mid 80s, so to 90. So it's really to try to forecast for a long life. That's where we get that 25 times your lifestyle costs. So to understand your lifestyle costs is really understanding what you're spending at the moment with no income coming in other than super. And it might be on things that there might be things that you cut out going into retirement. So some of the insurances you might cut out, not all of them, but if you're not working, you're not going to necessarily need an income protection policy. So there might be some little tweaks there, but often there's more costs involved because we do tend to travel a little bit more once we don't have to worry about getting 4 weeks holiday a year, that type of thing. So generally that's how that works. Did that cover that one off, do you think, Amelia?
Yeah, another question we had is how do I create a system so that planning for retirement becomes a thing that I do every day and not a one-off planning session?
Right. Okay. Well, so a good plan is the start. So we need to make sure that we have a good plan. So often people will write out a budget or a spending plan. We need to start to then automate things. So we always recommend automate all your bills. Make sure that you've got a regular payment going into your investment, whatever it might be. But try to automate as much as possible and keep it sort of, if you're a bit of a spender like I've been in the past, don't have it too accessible. But a lot of it is to do with having a spending plan, automating as much as possible. Make sure your KiwiSaver is in the background doing what it's doing, and make sure that if you're wanting to invest more than 3.5%, which is what goes into your KiwiSaver, make sure you've got it going into another type of fund that will grow. Or if you've got an investment property, make sure that you know exactly what's got to be paid there. To cover those costs if there is a shortfall. But I think the most important thing is having a good spending plan and tracking, because that helps you keep on track. So we have what we call Money Fit tracking at Enable Me, and that actually tracks your income and it tracks all of your expenses against your spending plan. So it really helps you understand if you're saving and not overspending. So it's a fantastic system. So it's really, really, it's great to see visually how you're getting on for the whole year, not just what's in your bank account.
Great. Our last question, this is a question from our chat, and I'm going to make this the last question because we're running out of time. So someone asked, can I really count on growth in the property market? We see more people selling their parents' investment property as it no longer really pays off, and achieving a good return on investment is much more challenging than it used to be compared to 10 years ago. And they're asking if you can speak more to that.
Yeah, it's a really difficult one at the moment because there's a lot in the media about house prices and that. And yes, we did see that big COVID bubble. So after COVID, house prices went up and interest rates came down. And then we had the bubble burst, which means the house prices came down and interest rates went up. And really, it was because of one and the other. So, probably in the last 5 years, we haven't seen a huge amount of growth in some of the main centres. Now, I do say that. If you're living in Auckland or say Wellington, you've probably noticed those decreases in house prices or maybe just holding steady. There might not have been a lot of growth, but that doesn't mean that that's the same around the whole country. So I'm living in Christchurch, and it's probably quite different down here, and it is a bit of a mindset. So I think if you are thinking about selling an investment property, think about, well, what are you going to replace it with? Because if you're going to have a pot of money coming out of that from the capital gains or mortgage repayments, you have to replace it with a different type of investment. I personally still think that property is a valid investment option. We have got inflation, so inflation doesn't stay away from housing. Housing gets more expensive to build because inflation puts the price of all the building expenses up. So I do think it will continue to go up. We've still got a bit of migration coming into the country. So I still think property has its place in your investment portfolio, but you also need to balance that out with having some other kind of diversified investment funds as well. So I think it's important to have both. But I definitely believe property is still a very, very valid way to invest for the future. I've got investment properties myself. I'm not selling them. I think they'll go up in value, and they are long-term investments. So hopefully that answered that question. And if not, come and see me or Teams me. Anything else there, Amelia?
Right. I think that was our last question. So thank you everyone for joining us today. If you have any questions about what we do, please feel free to get in touch. Our contact information is on our website. Karen, I'll let you close off.
Yeah, thanks, Amelia. Look, I really hope you got some value out of our session today. As I say, I'm quite passionate about this because I am getting ready for retirement, hopefully in the next 7 years, not 8 as my husband wants. But look, it really is important to have a good plan in place. It's good to have somebody with you to help you make the right financial decisions, and that's what we do at Enable Me. So please come and see us. We aren't scary. I know some people get afraid to go and see a financial coach, like back in the old days, dressing up to see your bank manager. But please come and see us. Don't put it off. Do it today. Book in, and we'd really love to see you shortly. Have a great afternoon.